Hello everyone, thank you for choosing this breakout presentation all about adjusting to the neo-normal, evolving the art of credit decisioning with AI and ML. Now, to talk us through just that, we have brought two brilliant speakers to the stage to dive deep into those topics. We have Atul. I will invite you to pop your cameras on, take yourself off of mute and take it away.
Thanks, Catherine.
Hi, let me introduce myself. I'm Atul Varshneya. I head the Artificial Intelligence and Analytics practice at Tavant. I've been working in the area of AI for more than 7 years, where I have been developing enterprise applications and platforms for applying AI to various enterprise applications. My interests have specifically been in the area of deep learning and reinforcement learning, for which I work with the top-notch professors at UC Berkeley, at University of Alberta. Today I'm happy to present to you about how we are thinking of applying machine learning to underwriting and fintech in general. Over to you, Vaibhav.
Thanks, Atul. Hello, everyone. I'm Vaihbav Sharma. I head the Banktech practice at Tavant. And my experience has been within banking and had that privilege of executing transformation projects, adapting to emerging tech in the last 25 years. What we have tried to bring out here is a viewpoint on Tavant's understanding of the marketplace and the industry expertise. This is based on a lot of experiences that we have achieved working with top-tier banks and across the spectrum of banking with credit unions, community banks, and mortgage lenders. So just to introduce Tavant, Tavant is essentially been a fintech that's been catering to the lending space with award-winning innovations, and hence it's the information that we have gathered through research is predominantly gives us some of those viewpoints that I would like to share. Now, lending in itself is a massive business, right? In the United States itself, millions of Americans holding loans worth trillions of dollars. And when I'm talking about lending, it's consumer, commercial, and across the spread. What's the need for AI and machine learning? And if you sort of drill down a little bit more deeper, lending at its core is basically a data challenge to be solved. And the things that we find still pervasive is the information, customer information that spreads across various assets that we want to loan. And the information is not only spread, it's also sporadically presented during the customer journey. So it's not entirely the institution, that lending institution's fault, I would say at times when we talk about experience. It's also because the customer is not ready, or they're not aware of what needs to be sort of put out there. The other challenge we see is that when it comes to assessment, creditworthiness, risk assessments, the traditional model and the formal model of FICOs and credit worthiness impedes from essentially reaching out to some of the other borrowers that essentially could be, that the bank or the institution wants to reach out to. So working with those kind of limited set of parameters or not having that expanded set of parameters built into the model is also a challenge. And as the loan complexity grows, we find that people get into more of human intervention. And one of the things that we find reflects well on it is that there's also the fear of adoption to auto decisioning and those kind of things, and where machine learning models are still sort of just reflecting the need, the information that is just required, the enough information that is required. You can always improve upon the personalized interaction. The personal experience is, with the whole acceleration to digital in the last year, has transcended itself into lending space as well. And we actually focus on that a lot. because the customer journey is essentially, the idea is that let's map out what the customer needs in their real world to their financial journeys. And then there is the opportunity of complete straight-through processing, where you can evolve the tools into the tools that we have today, and essentially build out a complete straight-through processing on digital lending. As we move to the next slide, I want to talk about some of the things that we are doing and how to essentially digitize this lending supply chain. The core concept and the core construct for us has been the hyper-personalization and hyper-automation. So first and foremost is when you apply for intelligent information assimilation. So information is vast and it's growing, right? And more for fintech purposes, I would say, and the banks will sort of, the regulators don't like it from a banking perspective. The digital footprint becomes essential, because more often than not, customers are actually spending time digitally. And if we don't tap into it, we lose a lot of the behavior aspects of the customer that essentially, can be assimilated at large. There is an interesting case in a separate marketplace where, in fact, for personalization purposes, there's integrated video call analysis for some of the SME lenders. And they have started to analyze the sincerity of the borrowers by actually looking at micro expressions. So you look at the intent and the commitment of the borrower, so that then now you can actually concentrate better on giving them a product. Sometimes customers just end up looking at just shopping. It's just window shopping at times. But when an informed customer is actually wanting to buy something, you can actually dive much deeper and can generate more information. Interestingly, there is one startup that aggressively used advanced machine learning to look through alternative data and to predict individuals' creditworthiness just on their digital behavior. So they claim that they had about 12,000 variables, including social media account usage, internet browsing, geolocation data, etc. And one of the credit bureaus actually signed up with them. And they did make sure that the privacy was still held up. They were not giving it directly to the lenders. But one of the credit bureaus actually used that model to basically bring in more risk profiling about it. The next aspect within the lending supply chain, after gathering that information where you can apply AI, is the personalized decisioning or the hyper-personalization. So speaking to your customer, understanding more in terms of their journey, the segmentation that they're looking at, and also sort of determining in terms of what their needs are becomes imperative. And again, I mean, there are examples where, there are startups that are actually working just on this aspect of it, right? So essentially they're streamlining one individual access and not making cookie cutter solutions. So that gives an opportunity that and you can apply some of the decision tree principles when you're actually helping customer chart out their journeys. And the third aspect of it is when you have is the opportunity to automate at scale, or the hyper automation. So essentially applying deep learning, closed loop feedback mechanism. You have the models, you monitor their performance, you look at the parameters, and constantly keep on feeding in terms of how these are actually effectively generating profitability, and then factor that back into the decisioning. So take all these and bundle it up as your insights to essentially decision. In all of this, the automation comes in at different levels. So you can have an NLP chatbot to help customer even use as digital assistants. From there on, you can actually have digital assistants for the underwriter. The underwriter is looking at a very focused single workstation where it has all the information, the transparency through the notifications and monitoring alerts. So there is this whole vast opportunity that's essentially available across different loan scenarios. The three interesting things that supported and are a byproduct of this, or can be used as byproducts of this, are smart decisioning engines, where you basically have the predictive modeling, scenario analysis, what if in real time, adjusting risk profile with macroeconomic conditions changing, creating a digital loan file, sort of a canonical data model that's essentially highly can be used across the loan and the journey, and adjusting it as and when the conditions are changing. Having all of that, how do you ascertain? Because now you have created a digital asset, you need to protect it, and digital vault is a great opportunity. So apply some of that innovation, and it may sound something tending towards blockchain's kind of environment, but you can actually limit access and accessibility by the prime user and have it protected and share, from who do they want to share with from the service providers. So this is in totality that we actually aim to provide from our digitized lending supply chain from an automation perspective. And Atul will take you some of the granular details of it. Over to you, Atul.
Thank you, Vaibhav. Looking at in a broader perspective, machine learning is pretty well understood to have applicability across the entire life of the loan. And there are multiple machine learning models that bring business value to various stakeholders, starting from initial phase of discovery and shopping. There are use cases as like loan recommendations, models for advice and guidance to the borrowers, to models that score the propensity of the borrower to complete the application process, for instance. Then risk scoring, risk-based pricing models, various ML use cases for speeding up underwriting, which actually will be the focus of some use cases that I'll talk about today. And also, towards the later phase of the loan, models that are for default and churn analysis. So as I mentioned, our focus for today's discussion will be on various aspects of underwriting where ML has made a difference and can continue to make a difference for various stakeholders and bring more and more business value to the industry. Before we get into that, I want to talk a bit about some aspects of machine learning which need to be kept in mind when developing such solutions. There are, of course, many aspects that need to be kept in mind, but I have picked two for today, which in our experience are common issues. And we have seen those pretty often in our various engagements with our clients in the industry. The first is the point that relationship between the various features of the loan and the outcome being predicted, be it risk, be it prepayment, the relationship is significantly nonlinear. So here basically I'm showing results from a well-recognized paper from Stanford University, University of Illinois, and Google Brain. There was this paper that was published. And you see in this chart, for instance, the first chart showing the relationship between changes in interest rate and the observed rate of prepayment. Extremely nonlinear. Similarly, the relationship between unemployment rate and prepayment rates. For that reason, the techniques that inherently handle such nonlinearities are preferred, as they tend to perform better in terms of predictions of in terms of prediction accuracy. So such techniques include deep learning, which was the focus of this paper that I'm citing here. But there's no free lunch in life. So while deep learning or other ensemble methods like XGBoost or others, while they give better accuracy, they come with the issue of interpretability. They are basically black box models. And therefore, that brings me to the second point, which I wanted to bring up in today's discussion. In fintech industry, being able to explain the rationale of the decision is imperative. And that is where interpretable AI comes in. So interpretability helps with developing trust in the model, I'm reminded of a paper where they talked about a machine learning model that would identify wolves and dogs, basically be able to distinguish between the two. It so turned out that all the images of wolves had snow in the background. So when they actually applied interpretability on top of the model, they realized that the model was not detecting the animal, but was just detecting, is there snow in the background? And if there was snow in the background, it would just say it has to be a wolf. So that shows that you cannot trust a model unless you know why it is making the decisions that it is. So that's the first part. And then providing rationale behind the prediction, it helps with regulatory compliance. Now, these two themselves are of paramount importance in a regulated industry as lending. But even beyond that, explainability helps with making business decisions too. Knowing why a loan application is risky helps loan officers to advise the borrowers on those aspects of the loan so that they can actually make changes to what kind of loan they're applying for. And it can also help underwriters to focus on those aspects and thus help with better and faster decision making by underwriters. So having done these two, gone over these two aspects, let's actually talk about certain use cases that I wanted to talk about in the area of fintech, and especially focusing on the underwriting aspects. So these two use cases are more like two clusters of use cases. So the first is underwriting assistant. Here, basically what we're trying to do, the overall objective is to help speed up the underwriting process and to improve the quality of underwriting. So for that, there are multiple, these are the three areas that we generally are talking about and building solutions for. The first aspect of underwriting assistance is heat map analysis. Here, basically what we're doing is, given the loan application, we do the analysis and identify which aspects of the loan application are making the loan not a very comfortably non-risky loan. So if a loan is identified as not 100% green, then it is possible to apply explainability, as I was talking about in my previous slide, to identify what aspects of this loan application are causing it to be classified as such. That basically creates a heat map on the loan file, which basically directs the underwriter's attention to those parts of the loan application. And therefore, instead of having to look at the entire application, it basically tells the underwriter, these aspects are fine, but these are the ones that require further scrutiny. Why don't you focus on those? So that is the heat map aspect of the loan file analysis. The second is identifying inconsistencies in the loan. I'm not using the word fraud here because that's too strong a term, and there are lots and lots of solutions that exist. But what I want to talk about here is that there can be errors and inconsistencies in the loan file. And here, basically, we are looking at anomaly detection to find how is a loan different from the majority of the normal loans that are received. So based on that, it can actually identify the loans that do not conform to what has been historically observed to be a normal loan. So that way, the loan can be flagged, and again, it will help the underwriter to make a judgment of whether it requires very thorough scrutiny or it is not, or does not. And that, tied with the heat map, will also help the underwriter to make a decision faster. The third aspect of underwriting assistance is basically just routing the loan application to the right underwriter. So depending on the complexity of the loan, and complexity can be measured in many, many different ways, and not having much time, I'll skip that part. But we can score the application on complexity. We can tag the application on various skills that the underwriters will require to process that loan file. And using that, the loan application can be routed to the appropriate underwriters. And that basically leads to improved rate of throughput and quality of underwriting. Now getting into even a more narrow area of underwriting is the area of appraisal analysis. Appraisal analysis basically requires a lot of analysis that can be done, which a lot of them can be done through rules, but a number of other analyses can be done applying machine learning. The ones that are marked in blue are the ones where machine learning can actually help. So one is about doing natural language processing to identify incompleteness or unverified data in the appraisal form, as well as to identify some sentiment of the description by the appraiser. So for instance, typically you have checkboxes, but along with the text description of those, you can make a better decision. You can flag something that is not obvious. Then comes comparable analysis or comp similarity. We can look at the images of the houses and actually categorize those as similar kind of houses or not. Then there can be machine learning, computer vision, application where you can see some structural issues with the house or look for, specific areas like there's a for rent sign in a house which is actually put out for sale. Those kind of things can be brought to attention of the underwriter, some very specific ones. And finally, you can even look at images and identify that there is something abnormal, although you cannot pinpoint what the specific issue is. But being able to identify that there's something abnormal about the house can again be a very good information for the underwriter to make a judgment about making a decision about, as part of underwriting decision. So these were the use cases that I wanted to talk about today. It's we have some little time left for Q&As, and we'll be happy to go over those.
Absolutely fantastic. Thank you so much, Atul. So yeah, if you do have any questions, please do send them in either via the Q&A module or via the chat. We'll be happy to put them to both of our speakers. So I've got one myself here. Now, talking about the end-to-end digitalization of lending, what effect will quantum computing have on this related to decisioning and analytics?
That's a good question. Quantum computing actually is very relevant. The reason is that the data sets and the data points will keep growing. And as we move from the new customers from state of randomness into a state of predictability, using that whole concept of quantum computing, the entangled bits, qubits, will actually make the process faster, and I think it'll make it more accurate.
Do you want to add anything at all? Are you happy with that?
Yeah, absolutely. Yeah, quantum computing is in fairly nascent stages right now, but the impact of being able to harness the huge amount of compute capability that it brings is definitely something to talk about.
Super. Now, bias is an issue when it comes to AI in the lending industry for certain. And when you talked about explainability in AI, what is the way for dealing with bias, for bias in AI? I mean, it all starts with the data, right? If you've got dodgy biased data and then you're expecting the AI to not be biased, I mean, that's a huge part of it. But what would you suggest for that?
Actually, that's again a very relevant question. So as I talked about being able to explain the results in a regulated industry, bias is definitely one of the very important factors that you have to watch out for. I completely agree with the question, Catherine. So so talking about bias, as you said, bias basically stems from the data, and it gets incorporated into the data because of the human biases in various forms. First of all, when you're looking at historical data, the data, if it captures the decisions that have been taken historically, and if those decisions had bias in them, that will clearly reflect in the data itself, which can be source of bias. Second area that I can think of right now is the selection of data. For instance, there are cases where you are looking at mortgage data from affluent regions. that can have a bias towards the kind of behavior patterns that you see among the affluent demographics, or some of the regional biases. Third is, which basically deals with, and there have been many instances of that, where when you're doing interaction with the users and the user responding in a certain way, then the biases of the users are also kind of getting incorporated there. So there are multiple ways, and the bottom line is that data only reflects the bias of the humans, and it captures that. Now, to get around those, there are multiple technical solutions that at least I'm aware of. First of all, use less bias and more inclusive data. So that's more of a process rather than technical solution. Have data from various regions, try to see that the data is being generated by various categories of users. Then there are methods where you can actually, if you identify the specific kind of bias, you can zero out that bias in the data by actually looking for that bias. And by the way, this is an area of ongoing research and a lot of work is happening. But I'm reminded of a quote by, I think it was Andrew Ng, who says, we have better handle on handling bias in machine learning than we have in the humans.
I love that. Absolutely. We actually did a episode on data ethics yesterday in the Business of Data show, and Katia Walsh from Levi Strauss, who's the Chief AI and Strategy Officer, said that the important thing to remember with bias is you can never do enough when it comes to ethics and bias, and that there's always going to be a continued journey. And once you sit there and accept that, suddenly it doesn't feel as challenging because you always know it's going to be worked on. So, there's not going to be a goal where you go, oh, this is completely 100% bias free. I think, well, maybe in the future we can be hopeful, right? But certainly for now. Now, that is all the time we have for this session. So thank you both so much